There's an uneasy comfort in the way energy just works until the system is tested by crisis and disruption. We rely on the quiet convenience of electricity, gasoline, air conditioning, and heat, while the realities behind the meter or pump tell a more complicated story. Every episode of severe weather, market volatility, or supply bottleneck exposes how much our confidence depends on adapting to a shifting landscape. I'm Mark Roach, and this is FutureWise Energy, my commitment to defining what the numbers actually mean for our business, our communities, and what comes next. Some of us remember when oil wasn't just an economic tool, but a lever of global influence. During the Cold War, U.S. and Allied energy policy deliberately drove prices down, starving the Soviet Union of hard currency and accelerating the strain that eventually unraveled their economic engine. That strategy was clear-cut: manipulate the market, and the ripple effects would reach deep into the foundations of a rival superpower's stability. And it worked, but not without consequences for domestic producers here in the U.S., especially independents caught in the collateral damage of low prices. Now fast forward to today. The playbook isn't as simple, but energy still sits at the center of geopolitical tension. As of mid-July 2025, crude oil, West Texas Intermediate, WTI, sits at $66.67 per barrel. That marks a significant slide from levels a year ago, with prices down roughly 17% year over year and 5% just in the past month, signaling a persistent bearish tone. The driver? Robust U.S. production, global economic headwinds, and a more cautious approach to capital allocation. Rig activity reflects this mood. The Permian Basin in Texas remains the standout, with rig counts holding near 300. Oklahoma, the Bakken, and Rockies are showing muted growth, still trailing pre-pandemic highs. The Gulf offshore segment has settled into a rhythm of efficiency over sheer expansion, operators targeting higher returns, not just volumes. Now, natural gas is finding firmer ground. The Henry Hub price for July 2025 is averaging around $3.45 per million BTU, a notable rebound from last year's lows backed by rising LNG exports and elevated summer power demand. Futures suggest prices will remain in the $3.20 to $3.48 range through this season, with regional gas rig activity holding steady in the Haynesville and in Appalachia. Operators are pacing development against inventory and export capacity to avoid overextending supply. LNG continues to provide critical support to the market as European and Asian demand keeps U.S. gas exports flowing, even when pipeline reliability wavers abroad. Electricity demand continues to accelerate, breaking out of a two-decade plateau with over 2% growth year-to-date in 2025. Data centers, electrification, and the commercial sector are pushing total demand to new highs, while grid planners now monitor both traditional summer peaks and rising winter loads, especially in the Northeast and Texas, where electrified heating and EV charging are transforming seasonal consumption patterns. On the gasoline front, summer 2025 saw demand return to a pre-pandemic level at 9.15 million barrels per day. But the real shift sits in price stability. National averages hovered near $3.14 a gallon, nearly 40 cents below last year, with ample inventories keeping volatility in check and minimizing gasoline's impact on headline inflation for the first time in years. All these fundamentals are converging with climate-driven risk at an unprecedented scale. In 2024, the U.S. faced $27 billion disasters and incurred over $187 billion in damages. More than 80% of major outages since 2000 trace back to weather, wildfires, hurricanes, floods, challenging an aging grid not yet built for today's extremes. Restoration is slower, loss is deeper, and investment needs are more urgent. Electricity prices have surged close to record levels, driven by both demand growth and the cost of strengthening grid infrastructure. Meanwhile, while renewables expand, persistent supply chain gaps and permitting delays are tempering their impact. The importance of localized solutions, from microgrids to targeted storage, is growing where centralized systems or federal support falls short. The LNG boom helps underpin domestic production and support global partners, but brings new constraints on capacity and infrastructure that demand real-time problem solving. Ultimately, energy isn't just another sector in the economy. It underpins everything from household budgets to national security. Supply chain expansions reminds us that these decisions reverberate far beyond the balance sheet. The way forward isn't about chasing volume. It's about facing hard realities, investing based on evidence, and making resilience the new baseline. I'm Mark Roach, and this is FutureWise Energy, wishing you all the best.